Hi, my name is Ashley Rosser with Victory Fiduciary Consulting, and today we're going to spend a few minutes to review with you our investment process. At Victory, we use a very disciplined, non-emotional, rules-based process that helps to guide our investment selection and our investment monitoring. We have three long-term goals for all of our clients. Number one, we want to outperform the S&P 500 over a meaningful period. Number two, we'd like to find ways to reduce volatility. And number three, we want to take what the markets will give us. And some years the markets will be generous, and some years the markets will not be. And so we want to be able to make adjustments within our portfolios as a result of that. The first step that we need to come up with is, should we even be in the market? And what we know is that there's three main market drivers: technical analysis, fundamentals, and emotion. What we don't want is for our decisions that we make to be driven by emotion. Emotion is not a very good indicator when we think about how we should be invested. And so the first thing that we want to make a determination on is, should we even be in the market? And so the way that we do that is we actually look at 6 market indicators. 3 of these are long-term, 3 of these are short-term. And what we want to find out is, where is our best opportunity to be? Now, prior to March 2020, our investment process was the same, but the investments that we held were quite different than where we are right now. And so 3 of the indicators that we look at, like I said, are forward-looking, and they're more long-term. And then we do have 3 other indicators that are a little more short-term. One of the indicators that we look at is the relative strength between stocks and bonds. And in order for us to do that, we take the S&P 500, divide it by the U.S. Aggregate Bond Index, and if that comes on what we call a buy signal, that means that we should be probably taking equity positions in our portfolios. If we're on a sell signal, that tells us that equities or stocks are weaker than bonds, and we should consider avoiding stocks and adding bonds in. Another long-term indicator that we look at is the long-term positive trend of U.S. stocks. And so the last time this indicator went negative prior to March 2020 was in September of 2008, and it reversed back positive back in August 2009. And so this indicator is important. It's only gone negative 3 times in the last 20 years. And what it tells us is that when this does go negative, there's significant underlying issues within the market, and that we should certainly be taking caution when we see that. And so had we followed this matrix back in 2008, we would have missed 82% of that market downturn that we experienced. And so the matrix is pretty important, and it's been pretty telling when we look back in history. And so what we saw March 17th was a significant weakening that was beginning to occur in the market as a result of the COVID-19 pandemic. And so if you look here, this is all of the different asset classes and sectors that are given relative strength rankings. And at the beginning of March, you can see domestic equities far and away was the best place to be. And then it was then followed by fixed income, international equities, cash, commodities, and then currencies were last. And then in domestic equities, it further breaks down, and it showed us what had the best opportunity within that class. And so large cap, mid cap, small cap growth were the strongest, and then the value stocks would have been the weakest. And then also it shows the different sectors like technology, industrial. These are all areas that we had exposure to, but we avoided areas like energy. And so this chart really had been pretty unchanged for a long time. There were little minor incremental changes, but far and away, this is what this chart looked like for a long time. And then on March 16th, this is what that chart looked like. And as you can see, domestic equities was overtaken by currencies, cash, and fixed income. It fell to the 4th position within our relative strength rankings. And by the time this happened, our other short-term indicators had gone negative. A 5th went negative very shortly after that. And so we made the decision to raise cash in our clients' accounts as a result of these indicators going negative. And so since that has happened, this chart here just showing the S&P change from March to May. You can see that major correction that happened there towards the end of March. Then you can see the beginning of April, there was quite a significant rally. And then the market really stagnated after that. You see that there was a lot of volatility, ups and downs, but we pretty much ended where we started between mid-April to mid-May. Now, the last 2 weeks, we've seen a bit of a run-up in the stock market. There's been some hope on vaccines that caused the market to run up quite a bit. And so people have now been kind of starting to wonder, what are we thinking? Should we be getting back in the market? People are having fear of missing out. They're wanting to know, is the bull back? And should we be jumping all in and getting ready to go? And what we're saying right now is not quite yet. We still have concerns. One of the major concerns that we have is just how overvalued the stock market currently is. And so this here is the Buffett Indicator, and it really just shows us the correlation between total market cap and GDP. And so typically we want to see numbers be between 75 to 90%. That would be a neutrally valued, that would be a normally valued stock. Anything above 125 is considered to be extremely overvalued, and we're right now at about 145% on that indicator, just significantly overvalued there. Also, when we look at stock prices compared to corporate earnings, there is such a huge disconnect from reality right now. And when we look at the S&P 500, earnings were priced in at $140 at the end of 2019. Currently, those numbers are pricing in at $182. And that seems to be a little disconnected, if you will, when you think that the chances of corporate earnings actually increasing right now, when we look at the end of 2019, seems very unlikely. So how are we pricing in these values to be as high as they are? Well, the answer is that right now, the market's running on hope alone, and it's really not interested in the fundamentals and the technical analysis. But what we know is that eventually the technicals and the fundamentals will matter. And even though right now it seems like it doesn't in the short run, in the long run, they have to reconcile. The only way that this valuation issue can reconcile is corporate earnings are going to have to come up or valuations have to come down. And we are quite suspicious that corporate earnings would be able to increase that much, certainly in the short run. And we think that it's going to be quite some time before we get to that point. Another issue also too that we're seeing with the indexes are super concentrated right now. And what I mean by that is the S&P 500 right now, 20% of the S&P 500 returns was a result of 5 stocks. So think about that. Out of 500 companies, 20% of the return came from five stocks alone. So that shows that there's significant weakness in those smaller companies in that index. We haven't seen a concentration like that since the 70s. And again, just as a cause for concern, it's showing that the rest of the market is probably weak. We also have issues or concerns in the general economy right now. So this is a slide from Econ Pie. And so we're always in the midst of one of these quadrants here. We're always either in expansion, decline, contraction, or recovery. And we've been kind of hovering between expansion and decline for quite some time now. But what we saw beginning in April was the decline. We began to drift closer and closer to the contraction. And as you can see where that red and green is there, we're now fully into contraction, which would be recession territory. And so the concerns we have right now with the economy, I mean, we have a lot of them, but number one, when we look at the GDP for Q1, we saw negative 4.8%, which was negative. It was disappointing. But Q2 GDP is expected to drop by at least 30%. Some projections are showing up to 50%. I don't even think we can really wrap our heads around what that actually is going to mean for the economy, what that's going to mean for industries. It's going to be devastating. You combine that with the estimates that employment is going to reach 25%. I mean, 25% employment is something that our country, again, I just don't think that we understand what the ramifications of that are. You talk about the fact that 40% of workers making less than $40,000 a year lost their jobs in April. And I saw I read another publication that was put out by University of Chicago that said in April, if you lost your job, 40% of those jobs are not coming back. And so you think about that for a second. 40% of people who lost their jobs in April, their job has just now vanished. Guys, these are real numbers. This is real things that are happening, and we can't just hope it away like what the market's trying to do right now. So what's going on with the market? Well, I already told you before, we're running on hope. The market is always forward-looking, yes, but you can't run so far forward that you miss a whole cycle. And so what we know is that investors, they are actually very predictable when we look at their psychological responses at these cycles. And so you may have heard the saying that we should be fearful when people are greedy and greedy when people are fearful. So right now, I think there's a lot of greed going on in the market. So the market's overvalued. People are they're trying to get in. They have the fear of missing out. And so this is all emotion that's kind of running the market right now. My concern is that right now where we are is we're kind of in that return to normal bubble where everybody thinks this is fine, everything is now fine, but it's really not fine because we're just now beginning to understand the brunt of what COVID-19 did to our economy and the damage that's been done. We're just starting to get these numbers now. And so my concern is we've been running up on hope, market's running on hopium, but we're going to be hitting that second phase there after return to normal when we realize that there is other issues with the technicals and the fundamentals that have to be reconciled. So what do? So for now, we're going to continue to choose safety for our clients. We're going to remain on the sidelines for now. You know, I tell people all the time, we're investment managers. We're not cash managers. We want to be in the market. We want to be invested. We know that when we can move into the market, we're going to do it tactically, and there's going to be a lot of opportunity for our clients when that happens. We're going to find those areas of relative strength that are high. We're going to avoid the weaker areas. And we are really excited about that time. We just don't think we're there yet. We choose safety for now. We believe that long term, these fundamentals and technicals, they are going to have a day of reckoning with stock prices. And so, and when that happens and the market will then be a healthier place, then we will very eagerly enter back in to the market for our clients. But we just don't think that hope is a great investment strategy. It's not prudent. And so I leave you with a quote by Charlie Munger, who said, "The big money to be made isn't in the buying and the selling, but in the waiting." And so for now, we remain in this area of patience, and we wait until it's time to go ahead and re-enter. And when our indicators tell us, and our math-based, rules-based program confirms it, and not our emotions. So I thank you so much for joining us today. If you have questions, please reach out to us, and we look forward to speaking to you again. Please stay well, be safe, take care.